A very good morning to you all and welcome. I am Neil Smith, Head of Sales here at Hawksmoor Investment Management, and today we are delighted to host our first virtual roadshow of 2021, wonderfully titled by the inimitable Jim Wood-Smith as Bull Markets and Cold Turkey. Prior to covering today's housekeeping, thank you for those who've answered the poll. Very interesting and very similar in outcome to the internal Hawksmoor staff poll. There is a further poll to follow, so please do respond to that one also. So to start, usual housekeeping points. We're expecting to start to cover this session in just under 1 hour, which will include a Q&A at the end of the presentations. And to reassure you that if your internet should drop out or if you have any technical issues, the session is being recorded and will be posted on our website. 1 hour CPD certificates will be emailed to you post today's session. And finally, can I especially request that you complete the survey regarding today's event, as this helps us shape our future events. Joining me today are Sarah Saw, our CEO, Jim Wood-Smith, our CIO, and finally, James Clark, Senior Fund Analyst, who heads up our Sustainable World investment team. I'm delighted that we have nearly 200 attendees today, many of whom have got long-term relationships with Hawksmoor, and our plan is to further enhance your choice of Hawksmoor as an investment partner. For those new to Hawksmoor, a huge welcome. Today we'll really showcase our credentials as an excellent addition to your client-facing proposition. The key points being covered today will be a company update, and I'm sure you'll be aware of our exciting news that we've been acquired by the Hurstpoint Group, and Sarah will cover this off in her session. This will be followed in true Phileas Fogg style with a coverage of investment markets and opportunities by Jim Wood-Smith, and despite all the coronavirus despondency and political dispatches, there are actually reasons to be cheerful. And finally, James Clark's session will cover our sustainable world proposition and how this fulfills both financial objectives and requirements to influence positive change in the world. This is particularly useful as our Sustainable World Service ticks all the boxes for supporting the United Nations Sustainable Goals, and also COP21, which I know is very important to financial planners, given the FCA's and European Commission's requirement for ESG to be part of client suitability assessments. Please use the question facility as we go along, and these will be incorporated in our Q&A session at the end of the presentations. Any we don't manage to cover off today, we'll post them to you in a post-session roundup. So, moving to today's first presentation, I'm delighted to introduce you to Sarah Saw, Hawksmoor's CEO. Sarah.
Thank you, Neil, very much indeed, and a very good morning to everybody, and a very warm welcome to our second virtual roadshow. I'm absolutely delighted you can join us today. I have to say, when we did the first virtual roadshow 6 months ago, I didn't anticipate that we would still be in lockdown, let alone lockdown 3. So I hope you're all managing to cope, particularly in the cold weather. So much has happened in the last 6 months. And as I say, some of us are still sitting at our desks at home with little change to the way we're operating on a day-to-day basis. And yet so much has happened with regards to Hawksmoor, as Neil has just referred to. We agreed just over 10 days ago to exchange contracts on the sale of 100% of the Hawksmoor share capital to Hurstpoint Group, which is a wholly owned subsidiary of the Carlyle Group, a UK-based private equity. This deal will complete subject to FCA approval in, we hope, a few weeks' time, and it basically is a very historic and very exciting moment for the firm, and I, for one, am absolutely delighted to be part of this. We at Hawksmoor see this as a very positive move forward, and we're really looking forward to working with our new colleagues at Hurstpoint and at Harwood. But what does this mean for you and your clients? Well, in a nutshell, I would say little or no change whatsoever. You should continue to have the same access to the same contacts that you do already. Portfolios will continue to be managed in the same way and in the way that is suitable for your clients. And quite frankly, we will have more support to help you moving forward than we would have perhaps had as an independent firm. I'm delighted to say that we're enhancing our reporting process through our client portal. And I would strongly encourage you, if you haven't done so already, to sign up to this. It is not only a much faster way of communicating and a much more secure way of communicating, but it is also much more sustainable. And not only do we want to offer sustainable investments to our clients, but we also want to run the firm more sustainably. And this is an ideal way of doing it. But the main focus for us is on you and your clients and your needs and their needs. And this will continue. We will continue to put you and your clients at the center of everything that we do and offer you the best possible service that we can. I'm now going to pass you over to Jim, who's going to give you an oversight on the markets today and moving forward. Jim, over to you. Thank you very much.
Right, thank you, Sarah, and a very good morning to everybody from a particularly wet and windy Cornwall on this Tuesday morning. For those who don't know me, I'm Jim Wood-Smith and I'm Chief Investment Officer here at Hawksmoor. For those who do know me, I'm still Jim Wood-Smith and I'm still the Chief Investment Officer, and I am also that deceptively fresh-faced young person who you were looking at on the previous slide. For the next 20 minutes or so, we're going to have a run through the state of world markets under the guidance of the title of Bull Markets and Cold Turkeys. And what that's going to entail is that we'll have a little look back at what happened last year. And then we'll have a gander through the swings and roundabouts that we're all going to come across through 2021 in terms of the downside risks of the recovery, and also some of the tremendously exciting opportunities that we have as we go through the year. So let's just start with a look at a selection of the numbers from last year. So what I would like you to do, first of all, please, is to compare and contrast the colours of the red on the left-hand column and the blue on the right-hand column. So what we have is the performance of a selection of asset classes through the first half of the year in the left-hand column, where we know that the response to the lockdowns last February and March was a dramatic fall in global equity markets, which was subsequently followed by the extraordinarily large QE programs and a commensurately extraordinarily large recovery in equity markets during the second half. So that the overall outcome for global equity was a 12% rise, which was a remarkable outcome. And bonds, you can see, turned out broadly flat for the year. The exception, as you will have spotted and as you knew beforehand, is the UK, which was the standout bad performer. And we will do a wee bit on the UK towards the end of the presentation. But let us move on. And in moving on, I actually want to go back 5 years. For those of us, or for those of you who've been following Hawksmoor's presentations for a while, which is a good few of the number online this morning, you may remember back to the beginning of 2016, when we gave a presentation under the title Katie Lied, in which we were making reference and trying to explain how we thought that the behaviour of financial markets was very similar to those of drug addicts. and the financial markets were hooked on handouts, were hooked on quantitative easing, were hooked on free money, as it were, and that each time authorities threatened to withdraw that, they had a bit of a temper tantrum and started to get withdrawal symptoms. And the problem we were facing in 2016 was how would markets react as we went into a year which looked as if some of the quantitative easing cookie jar would be taken back. And 5 years on, the issue has never been more pertinent than it currently is. So last year, authorities, by which I mean central banks and governments, couldn't have done a great deal better as far as the economies and financial markets are concerned. And one has to give credit where credit is due. And authorities had learned the very painful lessons of the great financial crisis and the mistakes that they all made in 2007, 2008 and early 2009. And the response from authority, as soon as the scale of the economic damage from lockdown became clear, was to throw unlimited money at it. And it worked. And the throwing unlimited money was to the extent that the United States has resorted to helicopter money. And our helicopter money has broadly just been referred to as an enormous economic experiment and involves simply handing out money. And it will be the equivalent of somebody coming around, knocking on our door, asking how much we earn, and then giving us 500 quid or 1,000 quid. And when you get into economic experiments like that, it begs the inevitable questions of how is it going to end? What are we going to do about it? What's going to happen to all that money? So let us just look at the example of the United Kingdom, and our national debt is now £2.1 trillion. And a trillion is a very large number. A trillion is a digit followed by 12 zeros. And 12 zeros is more than is good for anybody's health. And the logical question is, how are we ever going to pay that back? And there's a very easy answer to that, actually, because we're not. And we're not because we can't. So even on just terribly simple maths, to halve that deficit, to repay £1 trillion, supposedly we had a government annual surplus of £10 billion, which we don't and we're never going to get. But an annual surplus of £10 billion would take a century to halve the level of the national debt. It's not going to happen. And other than a bit of tokenism, it would be best if we don't try. But the really good news from that is that it doesn't matter. And it doesn't matter because of this chart. And this is the yield on the UK's 5-year gilt for the last decade. So we start over on the left-hand side at about 2.5% yield. And we come right down to where we are now in the highlighted bit, where the yield is at 0, or actually slightly less than 0. And what that means is that the cost of borrowing for the government is nil. And when you've got a bit over 2 trillion quid's worth of debts to worry about, having a 0 interest rate bill is quite important. And that is also why the maintenance of that 0 interest rate is the single most important issue facing the Bank of England and the combined monetary authorities in the UK. Because if that starts to rise, if we start to get inflation worries, if we start to get belief that bank rate is going to go up, then the yield on gilts is going to go up. And if the yield goes back to where it was, let's say 1.5% or 2%, that 2 trillion quid that's the national debt, which currently isn't a problem, becomes a very big problem. And that is one reason why gold, in this very glittery slide, which was a particularly good asset to hold during 2020, will still be a very good asset and a very good hedge to hold during 2021. And then we come on to the second side of the risks, which is what happens when we start to feel better. Because when the vaccines start to raise economic activity, which they will, it'll be a bumpy road getting there, but the vaccines will make a sea change difference. The banks and the authorities will need to start reining back on the amount of the handouts. And when they start reining back on the amount of the handouts, that's when we start to get problems with the markets, because we know they don't like that. And the risk, perversely, is not that COVID is worse or that the vaccines struggle against the variants. That's a risk and a significant risk, but the bigger risk is actually that we recover too fast, too quick, and the central banks start to take their goodies back again, and markets develop a case of cold turkey. Right, if that's the bad bit, let's move on to some of the better stuff and some of the cheerier stuff. So we are approaching this like a kiddie in a multicoloured pick and mix sweet shop. And we're just going to touch on Biden and the vaccines and China. Yes, we are going to do a little bit on Brexit. And this all also fits within this sort of overarching question of, if not equity, then what? This has been one of the most powerful drivers of equity markets for the last decade, as bond yields have come down and down and remain there. The question is, well, if I've got money to invest and I don't put it into equity, where do I put it? And that remains a very powerful driver of global equity markets. Right, so Biden's 3 challenges, or as we coin it here, the 3 C's of COVID, carbon, and China. So let us start with COVID. And in putting this presentation together, I was thinking, what can we say about COVID that would be of value, that is not just a repetition of everything that you've heard and already know? And in seeking inspiration for this, I came to the lady on screen, who you will be recognizing as Barbara Streisand. And the reason that we have Barbara Streisand is to see if we can answer the question of whether we are going to go back to the way we were. And what we think is that the answer to that is largely yes. There's a lot of good stuff that's happened as a result of COVID and transition to a slightly different way of doing things. So the big trends for working from home or moving to a split working life, the rapid acceleration of online everything and the digitization of the high street, the development of localism, the need to travel less, the investment into the UK housing stock and the big upturn in the RMI cycle as people move to get space. Those are all going to keep going, and they're making the world, I think, a generally better place. But as the vaccines kick in and restrictions ease, we are going to go back to being social beasts, because we are social creatures, and the human desire to go to the pub, to go for a chicken peri peri at Nando's and to have a fortnight on a sunbed in Lanzarote, those are not going to change. And as soon as we can do those again, we are going to do those again. So the post-COVID world is going to look an awful lot like the pre-COVID world, but with a lot of very beneficial add-ons to it. And the second of the C's, carbon. So again, the same thoughts of what can we say about carbon that everybody doesn't already know and fully appreciate. And carbon for Biden is a desperately important issue. We know that he's a firm believer in climate change. Everybody knows that one of the presidential orders he did on his first day was to restart the process of going back into COP21, which James will come on to shortly. And we know that he's got 4 years of the previous administration to try to unwind, and that's all well known. But the point I wanted to try to get over is that he's pushing on largely open doors, because whilst the previous administration might have gone down their particular alley, corporate America and individual America has very definitely got to grips with decarbonisation. And the way that I wanted to show this was with the share price of Tesla. And so Tesla, everybody thinks, well, yeah, that's the stock market bubble story of 2020. And that may very well be right. But there's a more important point to this, which is the reason that Tesla has been picked on is because America gets that the future is electric vehicles and not internal combustion engines. So yes, the stock price might have gone crazy, and we all know about that. But the underlying reason for that is that investors, American investors, get that the hydrocarbon era is coming to an end. And so Biden, I think we'll find, is pushing on open doors in what he wants to do to accelerate decarbonisation. So the third of the C's, China. And to talk about China, I wanted to put up a nice looking picture of the port of Shanghai. And the point with China is that the trade wars have only one winner, was only ever going to be one winner, and it's not the United States. So whilst the US has been busy fighting itself and everybody else, China has been getting on with things. And one of the most significant developments of the latter stages of last year was the signing of what was called an RCEP, or Regional Comprehensive Economic Partnership. And after 8 years in the making, what this is a free trade agreement across most of Southeast and East Asia. So that is a free trade agreement that includes China, Japan, South Korea, and all of Southeast Asia. Now that is a very powerful trading bloc. And so with China, what we have is first into COVID, first strongly out of COVID. If we look at the Chinese economic data currently, it's good. It's back up at decade highs. And we have the formation of a very powerful Asian free trade bloc. And that's a tremendously important investment opportunity. So the lead of China and the lead of Asia is going to get stronger, and the investment opportunities that are coming with that are absolutely one of our core 2021 themes. So 3 C's, but only 1 B. And I did promise that we would do a bit on Brexit, and we'll do a little bit on the UK. So Brexit-wise, now that we're past the Brexit day, is this for better or is this for worse? Well, in about 30 years' time, we might have a clue. But probably until then, it'll be quite difficult to work out whether it was a good thing or a bad thing for the long term. And at the moment, we have an awful lot of noise, and genuinely nobody has any idea whether it is for better or for worse. So let us not worry about that. There are, investment-wise, though, different arguments to that. And to illustrate that, I just want to put up one final chart. So on the blue line, we have the last 2 years of performance of US growth stocks. And in the red line at the bottom, we have the performance of what we might call UK value stocks. And if you put yourself in the shoes of an international investor, you would probably think that your decision not to invest in the UK after the referendum in 2016 had been a pretty good one, because the UK has underperformed very steadily for the last 5 years or so. And other areas, particularly US growth, as we know, have done very considerably better. We are now, however, past the reason why we shunned the UK, which is Brexit. And I think that there is a very good chance that an international investor will say, we know where we are now, we know what the rules of engagement are. Businesses will have a few teething problems at the start, but they'll get on with it. And then if I look at that performance differential and valuation differential, I think I might have a bit of a punt in the UK. And so what I want to argue is that theory that the UK is due for a bit of a rally is a theory which has considerable legs. Portfolio-wise, what does that mean for us? Well, we try to split things up into 4 style buckets, which we call growth, compounders, cyclicals, and income. So the difference between those is very simple. Growth companies grow. Compounders grow at a slightly lower rate, but with a hopefully more reliable tone to it. The cyclicals are what there's the bucket where we include the COVID recovery stocks, the Brexit recovery stocks, the cheap stocks, and what we might call the old economy stocks. And income stocks are hopefully self-explanatory. But the balance that we're trying to get in portfolios currently still biased towards growth and compounders, but with an increasing exposure to the UK bounce. And that should hopefully give us exposure to both the ongoing growth and, as we say, the fact that we do expect that the UK is going to have a period of catch-up for a short while. And in trying to draw all this together, I was looking for further inspiration and came to Nina Simone. And Nina Simone is an inspiration I've not used since the end of 2008, 2009, at the end of the financial crisis. And in looking at 2021 and through to 2022, relative to where we were 2020, then it is a new dawn, it is a new day, it is going to be a new life, and we're feeling an awful lot better. And on that note, I thank you for your attention. We'll have another very quick survey just whilst we make the transition between my talk and James's. So thank you very much indeed, everybody.
Okay, thank you very much for voting in this latest poll, everybody. I believe that Neil will touch on the results in his concluding remarks slightly later on. Well, thanks very much for joining us this morning, everybody. Fantastic turnout to a virtual seminar, our first one of the year. Where better to be on a wet and windy West Country morning, particularly on a Tuesday. My name's James Clark, a fund research analyst based in Hawksmoor's Exeter office, ordinarily anyway, and I'm speaking as part of our seminar this morning about our sustainable world investment services, with a particular focus on COP26. So the agenda for my section of the seminar, as I say, focusing on COP26, but also touching on the broader sustainable investment arena, both last year and looking into this year, offering a recap of what we actually offer in Sustainable World and how it has performed. So let's get started with COP26. And we start by setting the scene. Focusing on 3 points regarding COP26. Firstly, what is it? Why is it important? And what might we expect to happen? So, setting the scene. Firstly, very basics. What does COP stand for? COP stands for Conference of the Parties, as in parties to the UN Framework Convention on Climate Change. So this is national states, members, and also some international bodies such as the European Union. So these governments and bodies are party to the UN Framework Convention. Therefore, Conference of the Parties is simply the name given to conferences where they all get together to discuss UN climate change planning. So the UN framework currently has 197 members, whose governments are committed to reducing atmospheric concentrations of greenhouse gases. This is an international treaty, and it dates from 1992. COP26 is simply the 26th major UN conference relating to this framework. And it was supposed to take place last November, but it was postponed due to COVID-19, postponed to this November. And it's taking place in Glasgow under the presidency of the UK. The UK's presidency is actually alongside Italy, which is hosting a number of the warm-up events. Now, at the very first COP, it was decided that the existing aim of developed economies, which was to stabilise their emissions at 1990 levels by the year 2000, was not adequate to prevent major climate change. Subsequent discussions at further COPs led to the Kyoto Protocol of 1997, which is really the next step on the UN climate change pathway. The Kyoto Protocol established legally binding obligations for developed countries to reduce their emissions between 2008 and 2012. After Kyoto, the next major step on the UN climate change pathway was the Paris Agreement of 2015, and this occurred at COP21. This is an agreement within the UN framework, and it covers climate change, adaptation, mitigation, and also financing. A long-term goal of the Paris Agreement is to limit the global average temperature increase to below 2 degrees above pre-industrial levels, with pursuing efforts to keep that limit to 1.5 degrees rather than 2. Therein, each country has to determine, plan, and regularly report on their own efforts to mitigate climate change and what contribution they're making towards the overall global effort. At COP19, the mechanism was created for reporting on these contributions ahead of COP21. The Paris Agreement requires them to be ambitious, to represent a progression over time, and to be formulated with the aims of the Paris Agreement very much in mind. These are nationally determined contributions, and they have to be updated every 5 years. And this 5-year update is the first major reason why, stemming from COP21, COP26 is so important. In early December, the UK updated its own nationally determined contribution, and that is for a 68% reduction in emissions by 2030 relative to 1990 levels. It's updated because the previous nationally determined contribution, which was a 53% reduction, was submitted when the UK was part of the EU. So following Brexit, we needed to resubmit, and it's been increased to 68%. That's a hefty reduction. And that's part of the point here, because the UK can encourage other developed countries to weigh in with similarly strong and purposeful nationally determined contributions. More broadly, COP26 is really a great platform to advance the whole UN climate change movement. The world needs further significant cuts in emissions by 2030 and also net zero pledges. Last autumn, China came out with a net zero pledge for 2060 as their target date, swiftly followed by both Japan and South Korea coming out with 2050 net zero target dates, a time frame which matches the UK's now legally binding obligation. But at this stage, let's just pause and reflect on what net zero actually means, because it's a term that we've seen used a lot more recently, particularly in the media and particularly in the run-up to COP26. But what actually is net zero? Well, hopefully this graphic, and with thanks to the World Resources Institute for allowing us to use it, will be helpful in explaining what net zero actually is. So net zero is reducing emissions by as much as we physically can and then dealing with the remaining sliver. So in this graphic, business as usual emissions depicted by the red line, and then reducing emissions by as much as we physically can is the grey area, leaving as a result the blue area, which over time is hopefully much smaller than it currently is. Now at the same time, we can deal with the remaining sliver in green on this graphic, either by removing emissions from the atmosphere, such as developing carbon capture and storage technologies, or by offsetting them, such as reforestation schemes. And the balance, the aggregate line, if you like, between the blue area and the green area is shown by the dark blue line. And in this example, it passes through the zero band in the year 2050, hence net zero 2050. Again, thanks to the WRI for allowing us to use this graphic. And there's a link at the bottom of this slide to the blog that it features in and the link to the blog itself. But back to the UN climate change movement. And as Jim touched on, there's a big question here surrounding the US. How exactly is the US going to re-enter the global agenda in this respect? What will Joe Biden's approach be? What will the US nationally determined contribution look like? Because the US will now have to submit an NDC. And also, what will their net zero target date be, if indeed they set one at all? And there are big hopes and expectations in that regard. So quite a few questions at the moment surrounding the US, but hopefully also some real scope for positive developments under the Biden administration. More broadly on hosting a conference, the UK has not previously hosted a COP. And since the mid-noughties in particular, the hosting of the conference has been widely distributed across different continents and countries. Only 4 countries have hosted a COP more than once, led by Germany, which has hosted 4 times. So it might really be decades until the UK gets a chance to host again. And so therefore, this is a great opportunity, which the UK really needs to maximise. In that regard, there's going to be an international expectation on the UK to show leadership in this global climate change movement. But before all of this, the UK hosts a G7 Leaders Summit in June, and it's recently been announced that that will be in Carbis Bay in Cornwall. Diplomacy at the G7 Leaders Summit can really pave the way for specific outcomes to hopefully come through at COP26, which will be hosted here, the Scottish Events Centre in Glasgow on the banks of the River Clyde. So our third point on COP26, what might we expect to happen? Well, it's a 2-week programme, and the first week will mainly be technical negotiations between government officials. and the second week will see ministerial and heads of state meetings. There are a number of items to be carried over from COP25, which took place in Madrid in 2019. Firstly, carbon market mechanisms, which would allow the trading of carbon emission credits between different countries. How exactly should this work, and what should the rules be, and how should it be fair for both developed and emerging economies? On a related note, funding for less developed economies in mitigating and adapting to climate change. Now, the Paris Agreement included a pledge of $100 billion of such funding per year by 2020, with an expectation for this to be increased by 2025. Could that increase come through at COP26? Again related, loss and damage payments from richer to poorer countries, which can disproportionately suffer from the effects of climate change. Think rising sea levels affecting the Maldives and Bangladesh. And the fourth point here, nature-based solutions. How can ecosystem protection, agriculture and forestry be woven into a proper solution rather than just simply being nice ideas or nice points to have? So all of these things will surely be up for discussion at COP26. And on the sidelines, I'm sure we're going to see further companies announcing further net zero objectives and goals, speaking on the sidelines of the conference. So there's a lot coming up, and hopefully that's an interesting snapshot of COP26 and what we might expect to happen. Onwards to sustainable investment, because COP26 is really the main event on the agenda this year, and it's influencing the whole sustainable investment field this year, and it did so last year as well. It's a major event on the horizon. So a quick look back at last year, which was another very strong year for sustainable investment. Here's a couple of stats to illustrate this. Attendees might be familiar with the website Fund Eco Market, where we're very pleased to say our Sustainable World offerings are now listed. Last year, this website saw 17,000 unique users, a figure which was up 44% year on year. Logging in for 26,000 sessions, a figure which was up 46% year on year. The top 4 search terms entered into the website last year all relate to the excellent cohort of sustainable global equity funds, which we've spoken about a number of times previously and that we utilize within Sustainable World. The second point is from the Investment Association, the UK trade body for the investment industry. Responsible funds under management in their data set in November stood at £42.5 billion, a figure which was up 63% year on year, and yet still represents just 3% of all funds under management. So really growing, but still so much more to go for. Similarly, net retail sales of responsible funds in November stood at £1,077 million, a figure which was up threefold on the previous November, and now accounting for 13% of all net fund sales in the UK, which is a record high proportion for sustainable funds. So some really supportive stats on assets and effectively inflows. Next, a very quick look at 2 funds that we've become involved with recently within our Sustainable World services. And the first one you might have come across in the media because it's gaining more attention, it's growing and it's performing very well, as you can see from this chart. And this is 91 Global Environment, a fund that we've done 4 items of due diligence on before choosing to get involved. This is really a decarbonisation strategy, investing in three themes closely associated with decarbonisation and also offering structural growth. And these are renewable energy, electrification and resource efficiency. And the key concept here in the fund is quantified carbon avoided, which is seeing the managers work closely with some consultants to estimate the total scope of carbon emissions of companies, and therein focus on companies which are really doing their best to minimize those emissions and helping other companies do so as well. It's a really interesting fund. An even quicker look at Foresight Sustainable Real Estate Securities, which we've chosen to broaden the range of commercial property options available to us within Sustainable World, investing in REITs, which in turn invest in the likes of logistics, properties, warehouses, healthcare and social housing, currently focused on the UK and the US markets, with a primary aim for 4% yield, but also targeting capital growth over 5 years. An interesting little fund, only about 6 months old, but we think it's got really strong prospects and we've got good level of conviction in it. So hopefully, an interesting couple of quick examples on what we're actually investing in within Sustainable World. Next up is a quick recap of what these offerings actually are. So our Sustainable World services are available via 2 avenues, if you like: bespoke discretionary on the left-hand side and model portfolios on the right-hand side. Firstly, bespoke discretionary, where everything is exactly the same as for the management of what we might call traditional portfolios. So managed by the same investment managers, located in the same offices, using the same risk controls, asset allocation and procedures, with the only difference being that securities are selected from a subset of our buy lists, where we have sustainable funds, investment trusts and direct equities. And therein we can cater for specific client exclusions. On the model portfolio side of things, you can see our menu, if you like, of 4 Sustainable World model portfolios within our broader range of 12 models, which are now available on 9 platforms. Beyond financial returns, we're working on our other outputs. We can continue to do so, and there's a lot more development that we'd like to do here. We have our Sustainable World quarterly investors reports, and the distribution of these has recently been expanded beyond private clients who are signed up specifically for Sustainable World. So we are now distributing these to some intermediaries. We have hard copies available. This has already been emailed to some intermediaries, and it's also posted on our website. But if you haven't yet seen a copy and you'd like to of our very latest report, please do contact a member of our sales team. Similarly, we're very pleased to say that our Sustainable World model portfolios are now de facto ESG reviewed. And we have this lovely green logo on the right-hand side and a snapshot of just some of the pages from this in-depth report. And we have a specific report for each of our 4 Sustainable World model portfolios. So we're very pleased to achieve this. And we're also very happy to distribute this report. So again, if you would like a copy, please do contact a member of our sales team. That's all well and good, but how have these things actually performed? Well, in 2 words, we're pleased to say that the answer is very well. We have approaching a 4-year track record in sustainable investment. This graph is our best illustration of that. This is the track record of an internal illustrative Sustainable World portfolio with a moderate balanced mandate. And this is really internal guidance for our investment managers. This launched in March 2017. Since when, at the turn of the year, this portfolio was up by 30.8% against 15.6% from the ARC Sterling Balanced Asset comparator. Last year, this portfolio was up 9.3% against 4.8% from the same comparator. On the model portfolio side of things, our longest established model is the moderate model, which has been around since July 2018. Again, as at the turn of the year, this portfolio was up 16.8% against 10.1% from the same ARC comparator. Last year, up 8.2% against the same 4.8%. So in both bespoke and models, we're building a really good track record. Our performance is going well, and our process continues to evolve. So very quick recap, what have we covered this morning? COP26, what is it? Why is it important? What might we expect to happen? We've had a quick look back at sustainable investment last year, another very strong year. Looking into this year, a quick recap of our Sustainable World offerings and how they've performed, which we're pleased to say is very well. Thank you for listening to me, and I believe we are handing back to Neil to conclude. Thank you.
Thank you, James. We've just got enough time to cover off some questions. So the first one, Jim, I think focus this one through to you, particularly following your presentation. You're saying that doubts around the UK have put off global equity allocators, and this could now dissipate. And with the resultant inflows, this could remove the handbrake from the UK equity market. Do you think that that trend will lift sterling? What do you think, Jim?
The sterling question.
Indeed.
Yeah, there's already been quite a lot of support for sterling. It's been quite strong the last month or 6 weeks or so ago. The crucial level for it is 140 against the dollar. 140 against the US dollar was a multi-decade support level. And if sterling's going to hang on to the gains that it's made, it's got to get above 140. If it doesn't, then it's going to stay. Then it's going to stay weak, which is a bit of a cop out of an answer. But long term, sterling is still a structurally weak currency. But in the very short term, whilst this UK trade is playing out, then it might have legs in the short term, but it's struggling long term.
Thank you, Jim. There's a couple of questions regarding your session, James. I'll combine a couple of them. The first part is very much, is there a bubble around ESG darlings? Nice question. But also ESG and passive investing, both are hugely popular. And do you think that they can coexist?
Okay, thanks, Neil, and thank you for the questions. Okay, so firstly on sustainability darlings, effectively, I think there's definitely some valuation risk in sustainability darlings, and Jim's touched on Tesla, which is a classic example. But there are a few other notable darling stocks within sustainable investment. I'm not sure it's a bubble, but there's definitely some valuation risk there, some excessive valuations, and what we really like to see is our chosen fund managers reacting to that by trimming or exiting positions and recycling into better valued opportunities. So that's definitely something to watch out for. And on the direct equity side for us, we have been doing the same within the sustainable world stocks that we invest in directly. On the passives point, it won't surprise regular attendees to hear that we're not a huge fan of passive sustainable investing. There's always the potential for nasties, if you like, to slip through the net. Just recall the Boohoo debacle last year, although that did actually catch out a couple of active funds as well, but passives were invested as well. And another angle here is the different approaches by different sustainability ratings agencies. And again, touching on the Tesla example, I believe it is MSCI which rates Tesla very highly based on the avoidance of carbon emissions of its products. But FTSE Russell, another sustainability ratings provider, an index provider, rates Tesla very lowly based on corporate governance concerns. So a passive offering which tracks an MSCI created index will have a whacking weighting in Tesla, and another which tracks a FTSE Russell created index will have a negligible weighting in Tesla. Now, not to say that either is right or wrong, but the point is that the investor at all different levels of the chain, if you like, needs to really understand that and be comfortable with that and make sure that they've chosen the right index to track. On that point, there's also a proliferation of these indices. So how do you choose which index to track and which exact product to track it with? So there's a lot of question marks for us. We will prefer our chosen sustainable funds, our active funds, where we've done loads of due diligence, have great relationships with the managers, great flow of information, and we understand exactly what they're doing.
Thank you, James. One for Sarah. Great question. Excellent news on the acquisition. Could you outline your plans for Hawksmoor in the medium to long term, please, Sarah?
Yeah, no, I'd be absolutely delighted. As you say, it is a very exciting opportunity and gives us the chance to grow. We want to see both our investment management side grow and the fund management side grow. We are on the cusp of announcing the opening of a new office, which is very exciting, and we hope to continue in that vein. We will continue on the investment management side to run both business models, which is looking after private clients directly, as well as through intermediaries such as the audience we have here today. And we will be delighted to continue to service you and your clients as best as we possibly can. But we've got some very exciting plans, lots of exciting conversations, and you're definitely going to see a lot more of Hawksmoor in the future.
Thank you, Sarah. We've just got enough time for one final question, and I'll pick on Jim again. Jim, with all the largesse regarding central banks, how do you factor risk inflation into your thinking? Maybe, James, we could pull you into this one as well, please.
Yeah, sorry, Neil, could you just read that one out again? I just went a bit digital.
No problem. So, with all the largesse from central banks, how do you factor risk inflation in your thinking?
Right. Answer that one very simply. The biggest hedge against inflation is to hold equity. We hold gold, which hedges everything when the market is in the mood for so doing. Prolonged inflation, as I was trying to show on the 5-year gilt chart, is a very serious threat. And if we get prolonged inflation, then everything is going to struggle. If we get short, sharp bursts of it, which is much, much more likely, then the impact on markets will be fairly limited. And your best hedge against it is both equity and gold.
Thanks, Jim. James, anything to add at all?
Yes, Neil, thank you. I think beyond, yeah, quite right to touch on equities and gold, but I think also highlight within REITs and within other property and infrastructure investments, particularly closed-ended, that we choose to get involved with. We always look at inflation linkage of revenues and of contracts. And I'd highlight a couple of examples in this regard, things that would hopefully serve as real ballast with really good inflation linkage, such as SDCL Energy Efficiency Income Trust, and also Gresham House Energy Storage, one of the two battery storage investment trusts on the market now. So we always consider inflation linkage of their revenues when assessing these kind of options, whether that's for Sustainable World or for what we might call our traditional portfolios.
Thank you both. In the interest of time, I'm going to call a close to the question and answer session now. We will come back to you on, there's several other questions that will come back to you personally on the ones that have been posted. So thank you for that. Can't finish off without making reference to the polls. I think my sense is that we're going to be queuing up for the vaccine quite quickly, and I think we're all going to be summer holidaying in the UK, is the sense that I get. So in order to bring today's session to the close, I wanted to thank all of the presenters and the audience. Great content and some very, very good questions. Thank you for those. We certainly covered a lot within the hour or so. So in summary, I believe we've reaffirmed Hawksmoor's position as a credible partner to the financial planning community, that there are great investment opportunities out there for your clients, and the meeting of their investment, sustainable and environmental goals can be achieved, and certainly partnering with Hawksmoor, with a long-term proven track record in this area, is an excellent choice. I cannot also miss the opportunity to highlight our 4 investment solution strengths, namely our bespoke discretionary management services, our platform-based model portfolio services, our award-winning AIM services, and highlight once more our Sustainable World Service. Should you wish to hear anything more about these services, then please do let me or any member of my team know. And finally for today, and very timely, I'm delighted to announce that we've just heard that we've attained our 2021 de facto 5-star and diamond ratings for our services, which is great news and further third-party affirmation of the service you and your clients can expect from the fantastic team here at Hawksmoor. Thank you again for listening and participating today. And I wish you a great rest of the week and a very successful and healthy 2021. Thank you all.